In this lesson, we will look at constructing the balance sheet from this booklet. We will be starting on page 35, exercise 16. And so we're looking at Sam's ledger here, Sam's opening balances, and they are cash, $8,000, motor vehicle, $3,000, correction, debtors, $3,000, motor vehicle, $15,000, creditors, $2,500. And from here we can see we have cash, which is an asset account, debtors, also an asset account, motor vehicles, a non-current asset account, and creditors, a liability. To calculate our opening capital, we need to add up all our assets, total assets minus liability equals our net assets or our opening capital. So let's have a look at that. Motor vehicle, correction, all our assets equal $26,000 less our creditors equals $23,500. So that's how we've calculated our opening capital. And then we have three transactions. So let's have a look at these transactions for June. On the 1st, Sam paid $1,000 to his creditors. On the 4th, Sam withdrew $500 out of the business. And on the 10th, Sam received $2,000 from debtors. And what we're doing here in this exercise is continuing with the duality concept, where every transaction has at least two effects on two different accounts. So, for example, on the 1st of June, when Sam paid $1,000 to his creditors, his bank balance will decrease by $1,000. So I'm writing minus $1,000 in here on the 1st of June. And the other account that will be affected when Sam pays his creditors are the people he owes money to. They're a liability. When he pays his creditors, the balance of his creditors account, which is a liability account, will also decrease. So we can see here we have maintained the accounting equation. An asset has decreased and an liability account has also decreased. Now, on the 4th of June, Sam withdrew $500 out of the business. So when Sam withdraws $500 out of the business, $500 is going to come out of his cash account, and $500 is going to be put against his drawings account. Let me just move this aside. Here we are. So we record this as minus $500 next to his cash account, but I've recorded a plus $500 here next to his drawings account, because drawings is an equity, but it deducts from equity. It's like a negative equity account. The more drawings you have, the more you draw down upon your equity, the less equity you'll have left in your business. So the accounting equation has still been maintained here. Assets in the form of cash has decreased, and by increasing drawings, we are actually decreasing equity, even though the balance of the drawings account increases. As drawings increase, equity decreases. And so we have maintained the accounting equation here. We have this duality. Now the last transaction is on the 10th of June. Sam received $2,000 from debtors. So let's have a look at this. We received $2,000 from debtors. Debtors are those assets that people have made purchases on credit. They owe us. So the opening balance was $3,000. It's a current asset. They owe us. Our debtors owe us, and they have paid $2,000. So their balance decreases by $2,000, and our cash balance increases by $2,000 as well. So we have an increase and a decrease in assets, and our accounting equation is maintained. Let me move this away. Now, on the last column here, our closing balance, we simply add up along the rows. So our cash opening balance was $8,000, minus 1 is $7,000, minus 5 is $6,500, plus 2 is $8,500 in our closing balance in our cash account. Debtors, we started with $3,000, we decreased by 2, and so our closing balance in our debtors account is $1,000. Motor vehicle, no change. Creditors, we started with a balance of $2,500. It was decreased by $1,000, and so our closing balance is $1,500. Now, our capital account for the moment may be $23,500, but we do have this $500 worth of drawings. So our opening capital, $23,500, less the drawings, that'll make that $2,300 exactly. That could be called an error there, I think. So that's what I want you to do with these tables here, is just to record the transactions. There they are, 3 transactions. Here they are here. Record them in columns. I don't want you to carry over the running totals in each column. It's a lot more easier and simpler than that. From here, let's have a look at exercise 17. I might just go over to this page here. Won't have too much on it. Here we are, exercise 17. We've got some opening balances here. This is pages, books, and these are March transactions for page. 5 transactions, 5 columns here for those transactions. So enter the account names down here. You can calculate the opening capital, put that down there as well, and then put in your transaction for each transaction for the 1st of March and the 2nd, 3rd, 4th, and 5th, and then calculate your closing balance. And then with those closing balances, there'll be a couple of other accounts there that aren't listed up here. You can create a balance sheet for page, including the statement of changes in equity. And here it is, statement of changes in equity for page. For the year ending, put in the date there. And here we have opening capital, and it says capital injection there, so I assume one of those transactions was a capital injection. Page contributed $10,000 to the business. That's probably it there. And our closing capital. And our balance sheet as at, put in the date, and you can carry down the equity balance from our closing capital. And then we want to populate our balance sheet with these account balances, the closing balances. Okay, here we are, equity represented by our assets, current and non-current assets, total assets, so put that in there. There's no box for that there, but you'll need to put that in. Less liabilities, current liabilities, put them in there. And then we deduct our total liabilities from our total assets to give us our net assets. And our net assets should equal our equity figure here from our statement of changes in equity there. That's how we know we have done things correctly. If we've got all the details here, and it's easy to fill out the statement of changes in equity, carry down that closing capital balance to our equity here, and when we calculate our net assets down here, it should equal our equity. If it doesn't, something's wrong, and we need to investigate it and make it right. There we are. Exercise 17, folks. Away you go.